Welcome to the 3 Edge Week in Review for the week of September 19th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. Today, Steve and I will focus on this past week's meeting of the Federal Reserve's Federal Open Market Committee, and we'll discuss the Fed's decision to increase short-term interest rates by another 0.75% or 75 basis points. And we'll get into what this could mean for the economy and the markets from here. So, Steve, let's get right into it. The consensus on Wall Street was that the Fed would raise short-term interest rates by another 75 basis points this past week, and that is precisely what they did. That's what we got. However, it did kind of feel that the action by the Fed, along with comments from Fed Chair Powell during his news conference, and the release of the Fed's latest dot plot, all seem to point to a Fed that wants there to be no doubt that they intend to seek to rein in inflation, even if that means weakening the economy, increasing unemployment, and even the possibility of an economic recession. So perhaps you could shed some light on this week's decision by the Fed. And actually, while you're doing that, could you also, if you don't mind, explain a little bit about the dot plot, what that is, and why that could be significant and it's important for investors to understand? Turn it over to you.
Be happy to, Fritz. And I want to start off by just saying that you and I had a conversation many months ago about the Fed working themselves into their own trap where they're going to find themselves between a rock and a hard place. And what we meant by that, and it's very relevant now, is that they waited so long to remove the stimulus, all the printing of money and the zero interest rates, that they were going to have to catch up because inflation got out of the bag. And they have a dual mandate. One is to keep inflation contained, and the other is to keep the economy strong and unemployment low. And we recognized that they were going to be between a rock and a hard place because they waited so long. They would have to raise interest rates, we reasoned, so quickly that they would risk putting the economy in a recession, killing the stock market rally at that time by chasing inflation, or they would have to decide, no, they don't want to do that, and then they risk inflation getting even worse. And so here we are several months later, and it's exactly what happened. They waited too long, and often the Fed does wait a bit too long, this time more than most. They've had now 3 consecutive rate hikes of 75 basis points each. That is unprecedented. And I think the biggest disappointment that the markets had was hoping that there would be some kind of signal or sign that maybe they're done for now, maybe they'll pause, see what the effect of these recent rate hikes have been. But what Chair Powell did at this conference was he reinforced what he said a few weeks ago back at Jackson Hole. And he made a choice. He's picking the hard place, so to speak. He's saying, look, we're going to prioritize fighting inflation, even if it turns the economy in a recession, even if it hurts the stock market, even if people are going to go through pain, because if we don't fight inflation now, it's going to be a much worse problem later. So he made the choice. He really emphasized it. The market was hoping for a softer response, but he didn't oblige. And so now the idea of a soft landing is getting dimmer. The idea that we're going to have a few more rate hikes is getting more strong. And you mentioned dot plots. Well, dot plots are simply a compilation of every Fed governor's projection as to what rates are going to be over the next few quarters. And when you put it all together and average all the different governors, the average suggests that rates are going to keep going up almost another 1.5% or 150 basis points, which is still a long way from here. So the idea that they might be close to stopping kind of went away. There are more rate hikes to come.
Well, so there's another aspect of this, the Fed decision, and I think it's kind of interesting, and that is the effect that it's having outside of the U.S. And so perhaps you could speak to the impact of the current Fed policy outside of the U.S. why it's important for U.S. investors to understand the ramifications of Fed policy on the currencies and the economies of other countries.
This is a really important point you bring up, Fritz, because while the Fed legally has a dual mandate and it's all US centric, they are required to do their best job to try to keep US inflation under control and to try to keep the US economy supported and unemployment low. They effectively are the world central bank because the US dollar, our currency, is used by all the major central banks, all the major countries, as the reserve currency of choice. So all over the world, countries' central banks have reserves that result from their savings. And the vast majority of these reserves are in US dollars. So whatever the Fed does has a big impact on the value of the US dollar relative to other currencies.
Mm-hmm.
And then that has a big impact on inflationary pressure. So what's happened is the Fed has been leading the charge, hiking rates. That causes the dollar, the US dollar, to get much stronger than other currencies because people can make more interest by investing in the US dollar than in other currencies where their central banks haven't been as aggressive raising rates, at least up until this point. Well, when other currencies weaken relative to the dollar, that just makes their inflation problem worse because they purchase crude oil, they purchase energy, they purchase food, they purchase goods using US dollars. It's the payment of choice. And so when their currency weakens against the dollar, prices effectively go up for them. It just makes inflation even more problematic. And that forces them to have to raise rates, maybe even more quickly than they wished. So by the Fed acting in the US interest as it sees it, it's causing the whole world to react, and it's going to increase the probability of a global recession as other central banks are forced to raise rates higher than they might otherwise have deemed. Now, people often ask, well, when will they stop? When will the Fed stop raising rates? Well, what we heard in this meeting is that they want to keep going until they're absolutely sure that inflation is going to come back down to 2% level. And that's going to mean, by their estimation, several more rate hikes. But in the past, when we analyze many similar cycles in history, what we find is that the Fed will keep raising rates until something breaks. And so in the 1980s, it was the Latin American crisis. In the 1990s, it was the Asian currency crisis and the Russian debt default and long-term capital management, a big hedge fund blowing up. There's always something that breaks. And this time, it could be that the world is so indebted, governments are so indebted more than normal. Many corporations have taken advantage of low rates and borrowed lots more money than normal, but now they're going to have to pay those loans back with much worse terms and higher rates, so they could be in trouble. So definitely, this is a dangerous situation, but they hope to get inflation under control at the risk of something breaking.
Excellent. So, as always, my final question is how investors might consider positioning their portfolios based on this week's action by the Fed to raise short-term interest rates.
Well, when we think about portfolio strategy and allocating assets, we have three dimensions to our analysis, or three types of factors. One are shorter term factors. You can think of those as behavioral factors. Two are macroeconomic factors, which have an intermediate term effect. And then three are long-term valuation factors. And so if we think of these three, we see that, and based on our model analysis, it's saying that we're getting substantial headwinds from both the macroeconomic factors and the behavioral factors. With the Fed raising rates so rapidly, the yield curve is definitely flattening, and that's not great news for the market. Right. Credit spreads are widening, which is also not great news for stocks or corporate bonds, especially riskier bonds. And then on the behavioral side, while the market kept trying to rally, we call them bear market rallies, it never quite broke its 200-day moving average, which is considered a classic sign that we're still in a bear market. And so not great for behavioral factors. So what our model is trying to tell us is that while it's always hard to predict the future, risk is highly elevated given what the Fed is doing, given these economic factors, given some of the geopolitical uncertainty, given the behavioral factors. And so we look at valuation as a guide to see, well, how bad could things get?
Mhm.
And like before, as we run our valuation models, they're saying that as an example for the US stock market, the SP 500 index, fair value is below 3,000.
Well,
That's
yeah,
still a long way down from where we are now.
yes, it is.
And it
Mhm.
sounds unreasonable, but when you look at a reasonable estimate of growth going forward, which is getting weaker, not stronger, when you look at the discount rate, discounting future earnings, that's the discount rate is getting higher, not lower. And when you factor that all in, it's saying that if the behavioral factors and the macroeconomic factors continue to be negative, if there's not some grand surprise that comes out of the blue that saves the day, then there is still potential downside that's quite serious. So we're continuing to recommend a cautious approach, especially with equities,
Mhm.
especially with the riskier bonds.
Mhm.
We continue to emphasize the highest quality credits, which are US Treasuries, but with low duration. So we're looking at very short-term Treasury bills, which are taking advantage of the fact that short-term interest rates now are over 3% and continuing to climb. Floating rate Treasuries, which get reset every week, which benefits from these rising short-term rates. We're intrigued by short-term TIPS, or Treasury inflation protected securities, because number one, the ETFs that buy those, that hold those, produce a dividend stream tied to inflation, which is still over 8%.
Right.
They yield a real rate of over 1%. So A plus one, that's 9% as a baseline. And then you get additional either capital depreciation or capital appreciation based on the difference between the nominal rate and expected inflation. And right now, the market is saying that it expects inflation to come down quite rapidly to 2% in about a year or two. Well, we think that's unlikely. So we think there's even a chance for capital appreciation adding to the 9% yield. So we like short-term tips. Finally, while they're suffering in the short term because of the strong dollar, we still think there's a role in diversifying into real assets, like commodities that own some crude oil, like gold. And it's less about short-term trading and more about how the world is still a very unsafe, uncertain place. Geopolitical uncertainty is only rising. And we could get another oil shock. Oil's prices have come down as we've worked down the strategic petroleum reserve, but now it's worked down quite a bit. As we start replenishing those supplies, that could add pressure to oil. And then gold could still suffer some pressure as the dollar strengthens in the short term. But at some point, when the Fed breaks something or decides that it's time to pause, that's when gold could really take off. So stay cautious, stay diversified, focus on the safest short-term treasuries.
Great. That is excellent, Steve. Really, thank you for providing your insight into the significance of this past week's monetary policy decision by the Fed. I think that, it did feel like it was a turning point of sorts. So it's very helpful to have you sort that out for us. So that will do it for Steve and me for this week. In the meantime, as a reminder, all of our videos are available on our 3Edge YouTube channel. In addition, all our videos and written commentaries are always available on our website, and that's at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.